Hello everyone, this is the second video in the Finlight educational series, and today we are going to be talking about investing. Before we start, let's think about what investments are. Investments are defined as assets or items acquired with the goal of generating income or appreciation over time by Investopedia. And as you can see, this is a very broad definition. When most people think of investments, they think of things like stocks, bonds, maybe ETFs, but investments are truly a broad category, and that's why it's important to learn about some of the more uncommon ones and understand what they do and how they can grow your money. So let's look at some of the types of investments. Here we have stocks, bonds, mutual funds, checkings accounts, retirement plans, including the IRAs, like Roth IRA and the traditional IRA, savings accounts, real estate, ETFs, certificates of deposit, and options. Now, it may seem confusing, but we're going to go into some of these in more detail in the next slides to make it clearer what some of these concepts are. Let's start with ETFs. ETFs are also known as exchange traded funds, and what they are a collection of securities, which are just investments that are bought and sold on the stock market. And these typically track a specific stock market index. For example, the S&P 500 has its own ETF. Investing in ETFs, what it really does is increase your portfolio's diversity because you're spreading your money over a wide variety of stocks, bonds, or other investments. And this example is the SPDR S&P 500 ETF Trust. And what that does, they have your money spread out over the technology sector, financial services, healthcare, and energy. So this is a really good option if you want to invest in stocks but you're not sure where to start because it allows you to diversify your portfolio but also in some way spread out your risk. You're not going to make a huge loss if a company crashes because you have multiple companies and sectors invested in. Mutual funds are investments where money is pooled from multiple investors and then managed by a fund manager who chooses the different types of securities to invest in based on the types of goals for that specific mutual fund. When you invest in a mutual fund, you're investing in a part of that fund and not the actual stocks or securities. So it's important to consider your goals when you're choosing the right mutual fund for yourself. This diagram is a great representation of how a mutual fund works. Investors pool their money into a certain fund, then the fund manager will choose equities, bonds, and different types of securities for that money to be invested in. Now let's go into certificates of deposit. Certificates of deposit are just savings accounts that pay higher fixed interest rates over a period of time. And these typically have a term associated with them, which can vary from as low as 3 months to 5 years. And these different terms basically say the amount of time you cannot withdraw your money from that CD account. And these interest rates are usually higher than normal savings accounts, but if you withdraw your funds before the end of the term, you have to pay a penalty and you aren't going to earn as much interest as you initially thought you would. That's why it's important to choose the specific term that will suit your needs. So if you're investing in a CD, you need to see, okay, am I going to need this money sooner or later? Is it okay if I'm not able to withdraw it immediately until the end of this term? And that's a big factor in determining the type of certificate of deposit you're investing in. Now let's go into options. Options are slightly more complicated, but I'm going to simplify them for you. They're assets that give investors the right to buy or sell securities at a fixed price for a certain term. So, what that means is that if you buy a specific type of option, and I have them down here, I'll go into them a little bit later. But if you have that kind of option, you can either buy a security at a fixed price or sell it at a fixed price. So, options are really good to reduce risk of investing in stocks and other securities because you get that set price. But it's also heavily dependent on market predictions. So, if you buy an option at a high price and then the market price goes down, you are basically making a loss because now you have to buy that security at that fixed price. Otherwise, your option is useless. So now let's go into the different types of options. We have call options and put options. Call options allow holders to buy their assets at a fixed price, and put options allow them to sell it at a fixed price. And both of these have short and long variations. So a short call option would be selling the right to buy the option. A long call is buying the right to buy the option. A short put is selling the right to sell an option, and long put is buying the right to sell an option. So, for example, short call would mean that you are selling the right to buy this option at a fixed price to some other buyer. That's kind of how it works for all of these. It's a little bit confusing, but it does get clearer. There's a lot of sources on these that have conflicting views, but I did a lot of research to find out what exactly a short call, long call, short put, and long put option is for you guys. So that was the investing presentation. Now we do always have that blue kit for you guys to practice. Here are all of my sources that I use to determine content for the presentation. Thank you all for watching this video. Again, all of my resources are linked in my website, which is down below in the description. So go and check it out if you want to look at the slides that I'm presenting or play the blue kits. This is the second video in our financial education series. So we're going to have savings, taxes, and loan management upcoming. Our taxes presentation is going to be presented by our guest speaker, who is a finance professional. So keep an eye out for that.